This is Sovrun, your guide to financial literacy. Today we're fixing a flaw in the Sharpe ratio. In 2023, NVIDIA and Meta had massive gains. Their Sharpe ratios looked decent, but their Sortino ratios were off the charts. Why? Because most of that volatility was to the upside, the good kind. The Sharpe ratio punished them for it. The Sortino ratio didn't. The Sortino ratio is the Sharpe ratio's smarter cousin. It only penalizes the bad kind of risk, the drops. Imagine rating a surgeon. You wouldn't punish them for patients who recovered faster than expected. That's a good surprise. You'd only count the complications. The Sortino ratio works the same way, only the bad surprises count against your portfolio. Here's the formula. Sortino ratio equals your portfolio return minus the risk-free rate, all divided by your downside deviation. That last part is key. Downside deviation only measures the volatility of negative returns. Let's walk through it. Portfolio return, 14%. Risk-free rate, 4%. Excess return, 14 minus 4 equals 10%. Downside deviation, 8%. Now divide 10 by 8 and you get a Sortino of 1.25. Compare that to the same fund's Sharpe of 0.80. The Sortino is higher because it ignores upside swings. Here's where it gets interesting. The S&P 500 has a Sharpe of about 0.45, but a Sortino of 0.70. Growth funds? Even bigger gap. Sharpe 0.65, Sortino 1.10. Manage futures strategies that cut losses quickly, Sortinos above 1.5. The more asymmetric your returns, the bigger the gap between Sharpe and Sortino. Cathie Wood's ARK Innovation Fund is the perfect example. In 2020, ARK returned 153%. Its Sharpe was 2.5, but its Sortino was above 4.0, almost all upside volatility. Then came 2022. ARK dropped 67% and the Sortino collapsed to below 0.2. It told you exactly when the risk flipped from exciting to painful. Here's the bottom line. The Sharpe ratio punishes you for big gains just as much as big losses. That doesn't make sense. The Sortino ratio recognizes the difference. Punish the pain, not the gain. It's the fairer measure for any strategy with asymmetric returns. And the Sortino concept isn't just for investing. It's quality control, measuring only defects, healthcare, tracking adverse outcomes, even customer service, counting complaints, not compliments. Follow Sovrun for more financial insights.